Hey everybody, how are you? Hope you're doing well. So as you know, there's a lot going on in the world, but this is a finance channel. So guess what we're going to talk about? Finance. So how is everybody? Hope you are doing well. So today we're going to talk about investing, and we are going from this magazine, The 10 Rules of Investing, A Simple Path to Wealth. So we're not going to be on here long today, about 10 minutes. All right. So what we're doing today is we are going over investing definitions. And so just to recap, some of the things that stood out last time, we talked about the definition of derivative contracts, which are futures and options. Those are some of them, and then there are more. But we talked about the definition of derivatives. Let's see, what else did we talk about? Some of the things that stood out. Um, Commodity, examples of commodities. Corn, oil, steel. Let's see what else. Earnings per share, profits over the number of shares. We talked about bonds, the definition of um, actually the definition of fixed income products. The definition of fixed income products. When you talk about fixed income, what's the first thing that comes to mind when you hear the word fixed income? Anybody, feel free to chime in. All right, so we saw that fixed income has another definition, and that it is the actual product out here called the fixed income product, and it is bonds. Let's see what else we talk about. We talked about an annuity. Everybody watching me have an annuity, or did you put on your to-do list? We talked about getting a support system, which, according to the magazine, their definition of a support system is the following: a financial advisor, a tax accountant, an insurance rep, and a state planner. So four people meets the definition of a support system according to this magazine. So did you do that, or did you put it on your to-do list at least? Um, and do you agree with getting a financial advisor? Because everybody does not agree with that. So put that in the comments. We talked about the Roth IRA. All right, so now we're going to go over some definitions for today. Passive investing, and we're not going to be on here long. So what time it is? All right, so we'll go about 10 minutes. How does that sound, everyone? Let me see what time it is, and then I'm going to stop in 10 minutes. All right, passive investing, an investment strategy to maximize returns by minimizing buying and selling. Index investing is a common passive strategy where investors purchase a benchmark such as the S&P 500 index and hold it over a long time period. Passive investing. So when you think about passive investing, do you think of buying stock and holding it as an example of passive investing? So this is what they're saying, the definition of passive investing. All right, PE ratio, a stock valuation metric that compares a company's current share price to its earnings share per share. Investors use it to determine the relative value of a company's shares in apples to apples comparison to others in the same sector. PE ratio as a stock valuation. So it's a way to measure if the stock is good or bad. A stock evaluation metric that compares a company's current share price to its earnings per share. So let's look this up. What is considered a good PE ratio? And the number 20 is coming to my mind for some reason. So but let's see what is. And if anybody knows right away, put it in the chat. What is considered a good PE ratio for a stock? Okay. A good PE ratio depends on the type of company and the context. There's no single magic number. Here's a simple way to think about it. Under 10, possibly undervalued or struggling. 10 to 20, often considered reasonable. 20 to 30, growth expectations priced in. 30 plus, high growth stock or overvalued. Historically, the overall market, like the S&P 500, averages around 15 to 20. So a PE around 15 to 20 is generally considered healthy. But context matters a lot. Growth stocks, higher PE is normal. Tech companies like those inside Vanguard Information Technology ETF often have PE of 25 to 40 plus because investors expect future earnings growth. Example mindset. I'll pay more today because this company will earn way more tomorrow. Number two, stable, mature companies. Utilities, banks, consumer staples, PE 10 to 18 is common. Lower growth equals lower PE. Number three, compare with the same industry. A 25 PE is normal for tech. It's cheap for AI. The real way to judge a PE, instead of asking, is this PE high? Ask, is this PE high? Is this PE ratio high for its growth rate? This is why investors use PEG ratio equals PE divided by growth rate. Quick guide, PEG. 1 means fair value. Less than 1 means undervalued. Greater than 1 means possibly overpriced. Simple takeaway. 15 to 20 is a solid baseline. Higher can be good if growth justifies it. Low isn't always cheap. Could signal problems. All right, so what I'm seeing here is that investors use something called the PEG ratio. They don't only use the PE ratio. And the PEG ratio is PE divided by growth rate. And they're saying that around 1 is a fair value, right? So one more time, PE ratio, a stock valuation metric that compares a company's current share price to its earnings per share. Investors use it to determine the relative value of a company's share in an apples-to-apples comparison to others in the same sector. Rebalancing, the process of returning the values of a portfolio's asset allocations designed to match risk tolerance with desire for reward to the levels defined by an investment plan. Rebalancing, the process of returning the values of the portfolio's asset allocations designed to match risk tolerance with desire for reward to the levels defined by an investment plan. Return on investment, A popular profitability metric used to evaluate how well an investment has performed. It's designed to directly measure the amount of return on a particular investment relative to its cost, expressed as a ratio or percentage return on investment. Risk tolerance, a measure of the degree of loss an investor is willing to endure within their portfolio. Stock volatility, market swings, economic or political events, and regulatory or interest rate changes all affect an investor's tolerance for risk. All right, so risk tolerance is um, how much an investor is willing to lose. Risk tolerance. Robo-advisor, a digital platform that provides automated algorithmic financial planning and investment services with little to no human supervision. Typically, it asks questions about your financial situation and future goals and uses that data to offer advice and automatically invest for you. So, does anyone watching me use a robo advisor? So, this instead of using a human being, it's a digital platform. You ask it questions, and it uses that data to offer advice and automatically invest for you. Anybody use robo advisor? Okay, spot Bitcoin, spot Ether ETF. An exchange traded fund that tracks the current Bitcoin or other price. Spot ETFs must own the cryptocurrencies directly. So the spot Bitcoin, spot Ether ETF. Is anybody in the Bitcoin ETF? Shareholder, a person, company, or institution that owns at least one share of a stock or a mutual fund. Shareholder. So if you own at least one share of a stock or a mutual fund, you are a shareholder. Hi, shareholders. So you're a shareholder. You own at least one share of a stock or mutual fund. Stock, also known as equity, a security that represents the ownership of a fraction of issuing corporation. Unit of stocks are referred to as shares. So a stock is also known as equity. Okay, tax loss harvesting. Selling securities at a loss to offset the amount of capital gains tax owed on other profitable investments. This strategy is commonly used to reduce capital gains taxes and taxes owed from selling profitable investments. Tax loss harvesting. This strategy is commonly used to reduce capital gains taxes owed from selling profitable investments. So if you sell a stock, then you're going to go own capital gains taxes on it. So tax and harvesting is a way to offset the amount of taxable. So has anyone done tax loss harvesting? That's something that you would do with your taxes. When the tax man sees that you sold some stocks, then they want capital gains tax paid on it. And so to offset that, you can do something called tax loss harvesting. Everybody did tax loss harvesting before. Okay, let's just do one more. I'm going to call it a technical analysis, a method of analyzing and predicting stock movements based on past market data, primarily price and volume. This can be used to evaluate and identify trading opportunities. Technical analysis. So this can be used to identify trading opportunities. All right, let's call it a night. So the thing that stood out for tonight would be anything stand out for you tonight? So the thing that stood out for me would be that stock is also known as equity, because when I think of equity, I think of real estate, but the stock is also known as equity. Anything stand out for you? Just to recap, we went over the definition of passive investing, PE ratio, rebalancing, return on investment, risk tolerance, robo-advisor, spot Bitcoin, spot Ether ETF, shareholder, stock, and tax loss devastating. And we're going to call it a night. If you would like to add anything, feel free in the comments. And we are going to call it a wrap. Do me a favor, if you like the channel, I need you to hit that like button. If you're not a subscriber, I need you to hit the subscribe button and notification bell next to it so that you will not miss an episode. If you are interested in improving your finances, check out the link below and join the free newsletter. So tune in. I will be bringing people onto the show. I interview entrepreneurs and people that own different types of businesses. So tune in and we'll see them on the show one day. All right. Thank you for watching, everyone. On your way out, don't forget to hit that like button. And I will see you on the